Stocks higher this morning after the hotter than expected inflation data sent the Dow to its lowest level in about a year. Well, not the lowest level, but one of the biggest declines that we've seen in about a year. What is the signal for the other economic data on tap this week? Thomas Simons, who is the Jefferies senior U.S. economist, joins us now. Thomas, great to have you here in studio with us. Why was everyone so surprised with this print, especially as we're just trying to make sure that a larger trend is locked in here?
Yeah, I mean, I think that for the last 6 months or so, most of the data and the news we've gotten on inflation has been generally kind of going in the right direction, right? And for a while, there's been this notion that the quote unquote last mile problem with inflation, kind of getting it down from a 3% annualized rate to 2 is going to be this big problem. Well, the data, especially as we saw it in Q4, was sort of arguing against that, right? It was saying that we were getting closer and closer, and it feels like yesterday's data was a retreat, right? It was a step back in that progress. The sort of nature of this hyper-focus on inflation and how it has such strong implications for what the Fed is going to do, it's just like there's a lot of attention on it, right? It's going to move the markets. People get very skittish.
And this isn't the first time that, we've seen sort of some of these blips with inflation here, but then also when you factor in seasonality in January's report, it was surprising to see this strong of a reaction. And I believe we were chatting about, is it about the absence of other things to worry about, that people are just super honed in on this?
Yeah, and I think it's also the problem that a lot of the economic data in general has been very kind of difficult to reconcile with each other, right? Like there's a lot of inconsistencies across different series. So whether it's looking at something like the establishment survey and the household survey within the labor market data, or if it's the PPI versus the CPI versus the PCE deflator, it's all very, very noisy, right? So, I have to admit that I forgot exactly what the beginning of the question was with that, but like the seasonality, right?
Yes.
So I've seen this argument. I think that there is some validity to it, but also if it's coming in higher than other Januaries, that means that the seasonal impact was bigger this year, right? And that's meaningful, right? Because that does mean that there are still these wage push pressures that need to be, kind of delivered through to consumers, especially in the service sector.
Absolutely. And so that considered, where for the consumers right now are we able to kind of draw a through line to a few of these different data points that have come out to suggest where there's still resiliency and where consumption is still holding up?
Yeah, I mean, I think that it's mostly going to be concentrated amongst higher end consumers on the kind of discretionary side, and they're enough to kind of keep things floating, but not enough to drive big growth, right? Mm-hmm. And I think if we look at the components of, especially within the service sector of the CPI, where we saw a lot of this pressure, it's a lot of different industries that have very low productivity type jobs, no discretion in demand, right? Like, water and garbage service, for instance, like you don't have an opportunity to shop around to different providers of these things. So as a consumer, you're just a price taker on that, right? The lower end consumer is especially it's almost like increases in gasoline prices, right? Like you have to put it in your car to go to work. So when they see these service sector prices continuing to rise, it just, it really eats into their budgets for consumption for other things.
Especially when you think of the things that really hit home for people. Shelter, and of course, your car and being able to afford auto insurance there.
Right.
And I know some of that data that we're still waiting to see some of this auto insurance, the lag still catching up here. Mm-hmm. Are you surprised that it's still this sticky?
Somewhat, yeah. I mean, I wouldn't have thought, because it's been very sticky now for about 2 years. Like it's been almost like, over 20 months, it's been like increasing over 1% month over month. And I mean, on the one hand, it makes sense, right? You have high interest rates, so financing everything is high, is expensive. Even though car prices have come down in the last few months, they're still, in aggregate much higher than they were a while ago. You have capacity constraints on how much, maintenance is real, sort of services available, because people couldn't buy used cars to replace old cars, so they're repairing more and more old cars, right? So just the whole ecosystem is that much more expensive, and the insurers are dealing with, again, the high rates to finance themselves, and the claims are all more expensive, so that just has to get passed along to the consumer.
How does this all factor into the Fed and what the real number of cuts we may see is over the course of this year from your perspective?
So I think the issue with the Fed is that they're looking at this, the bones of inflation, and I think if they're honest with themselves, they have to say, how much are interest rate cuts really going to, or even to think about, would more hikes really like slow down these bits of inflation? And I have to imagine the answer is really no. Like, a lot of it is not particularly either economically sensitive or interest rate sensitive. So unfortunately, what I think it ends up doing is it puts the Fed in a position where they have to keep being patient, like kind of like what we saw with the meeting a few weeks ago.
How far out does that patience, you think, extend to?
I think at least until June.
Yeah.
And even then, it's questionable whether or not they really have too much room to cut, barring some more significant slowdown in other economic data.
So given the reaction that we saw from the CPI data, we still have PPI on deck and retail sales as well. What are the expectations there?
So I think retail sales is the one where there's probably some underappreciated downside risk, right? Like within retail sales, and forgive me off the top of my head, I don't remember if there's 12 or 13 different categories, but 11 or 12 of them are goods related, right? It's only food services that is, kind of service related. And what we saw yesterday in the CPI data is the price of almost all goods is weaker, right? Nominal sales or retail sales is a nominal price level, not real inflation adjusted measure. So with prices being lower and lower, the idea that maybe people had to pull back a little bit after another strong holiday season, I think that we're very likely to see some more negative numbers. On top of that, we had a decline in unit auto sales. There just isn't much that leads me to believe that this month is going to be particularly good.
We'll continue to track those market moves when we get that reaction as well. Appreciate you joining us this morning. Thomas Simons, Jefferies Senior US Economist.